Asset management is defined by three pillars: discipline, allocation, and risk control. It operates as a strict, sequential framework rather than a series of isolated trades. The process begins with defining precise investor objectives, which dictate the strategic asset allocation. This flows into active portfolio management and rigorous risk control, culminating in the generation of long-term value. The operational mandate is clear: allocate capital across opportunities, control risk before return, and continuously review and adapt when market conditions change. A robust portfolio requires different assets exhibiting different behaviors. A standardized structural allocation divides capital among equities for growth potential, fixed income for stability, real assets for an inflation hedge, and liquidity for operational flexibility. The mathematical foundation of this strategy relies on low correlation. For example, equities and fixed income historically share a low correlation of 0.12, while equities and real assets measure at 0.18. Combining assets that move differently creates a fundamentally stronger, more resilient portfolio. Compounding builds wealth over time, proving that small differences generate significantly divergent future outcomes. Modeling a 30-year horizon. A portfolio yielding an 8% annual return reaches a value of $1,006,000. In contrast, a 6% annual return over the exact same period yields only $594,000. A mere 2% higher return mathematically doubles the final outcome over time. Achieving that outperformance is statistically difficult, as most active funds underperform their benchmarks. Data from the SPIVA US Year-End 2025 report demonstrates that 79% of active U.S. large-cap equity funds underperformed the S&P 500 index. Only a minority of 21% managed to outperform the benchmark during that period. This is the operational thesis of AM Capital, a quantitative investment firm. The methodology is a continuous feedback loop. Research provides data-driven insights, which feed into the portfolio for systematic allocation, protected by risk control to preserve capital first, and finalized with reporting that is transparent and accountable. The firm prioritizes rules before emotion and capital allocation over speculation. Structurally, the firm operates with a 12-month lock-up period, applying a 2% management fee and a 20% performance fee on gains.